All right, so let's begin the show. And today we're going to talk about an investment or investor trend that's catching up. So we all know a huge run-up in mid-cap and small-cap that investors must have seen. So now the new trend says that investors are moving their money to a safer category. And in this perspective, it's mainly large-cap, flexi-cap, and balance advantage fund. Having said that, the trend of investment in mid-cap and small-cap is again at an all-time high, and investor interest is still there, but at the same time a lot of it is getting transferred to large cap, flexi cap and balance advantage fund. In fact, the kind of numbers that we've seen are at record high as compared to the previous numbers. So how should we be looking at this kind of a trend, and what's the reason why investors are shifting their money to safer assets? And when we talk about overall portfolio planning or revamping, is this the ideal thing to do? Let's have on board Suresh Sadagopan, founder, Ladder 7 Financial Advisors, to talk more on this. Suresh, good evening and welcome to the show. So, is this kind of positioning in the portfolio or changing the portfolio quite common when we see a very longer run bull market? Have you seen this earlier? Should this kind of investor trend be expected? You know, people moving their money from riskier assets and coming down to safer assets, or the kind of market cap categories that have not shown such a high run-up?
I think you had observed very rightly that mid and small caps have run quite high and have given wonderful returns in the past. If you really look at the situation as of now, the Sensex Nifty, it's all hit the all-time high. And apart from that, if you look at the overall macro situation, India's macroeconomic situation largely is positive. But if you really look at the geopolitical situations and other indicators globally, they are not really that very rosy. So considering the high level at which Sensex and Nifty are currently positioned, and the kind of reports that we are getting as far as any possibility of a correction, there is also US rate cut which is expected sometime in the future. Probably today, later in the day. So, these pointers are kind of pointing to a fact that probably there could be a correction. And if there is a correction, probably it will affect the mid and small caps disproportionately. And there is a flight to safety towards large caps or large cap oriented funds like flexi caps. And balance advantage is another category where also debt is there along with equity. So it allows the fund manager to adjust the amount of equity and debt according to certain formulations that they have. So they have an underlying macro based on which they will calibrate how much equity, how much debt. So I think it is natural. This has happened in the past. It is natural that people are moving to safety over returns at this point in time.
All right, now, but then looking at the shift, in which category do you think within these three, the most of the money has gone, Suresh?
Yeah, it all really depends on one's requirement. A large cap, as far as the equity universe is concerned, large cap is one category where, a bulk of the action normally happens there. And that flexi cap as a category, it has a preponderance of large caps. There is also a certain sliver of mid and small caps. So if you really want to participate there, but you're not sure whether mid caps will fire, small caps will fire, and to what extent. So it's a flight to safety again, where you have large caps for the most part, but there is also an element of mid and small caps which can also give you that return. So flexi cap is a great category if you really want to participate in equities. You're not very sure. You're willing to take a certain amount of risk, and flexi cap is a great category. And as far as the other one is concerned, you're not sure. Your jittery balance advantage fund is a great category. It gives you the equity taxation because equity and the arbitrage portion together will be above 65%. And there is an element of debt, which is a stabilizer. And because of that, that's a great category for people who want an asset allocation component and also the fund manager to manage the risk in the portfolio. So from that point of view, all the three are actually well positioned, large cap being the largest of the lot.
Suresh, now the whole point is how much of a proportion should one be keeping in their mid cap and small cap, considering that investors are moving into large caps and flexi cap, which are also largely large cap, the kind of funds we have. And a lot of them have actually opted for dynamic asset allocation. There too, what we've noticed is the choice is slightly aggressive hybrid funds, where again we see a good amount of exposure in large and mid caps at least. What should be your approach in mid cap and small caps? Not that we've seen the investment numbers coming down in these categories, but will we also see that kind of a trend where eventually the reports or the numbers would show investment coming out from there and going to a large cap category maybe?
Yeah, as far the large cap category is concerned, as compared to the other two categories, mid and small cap, that is the slightly more stable of the lot. So, I mean, there is no one formula to say that so and so amount of mid cap or small cap should be there in the portfolio. It is part of the larger assessment of the client situation and what kind of asset allocation is required. And that is how we normally allocate towards large cap or flexi cap or directly mid caps and small caps. So only when somebody has real high risk appetite should they consider mid and small caps. The halfway house is probably a flexi cap where you want to participate to a certain extent in mid cap and small cap, and probably that is where a lot of people are moving their money into flexi caps, where they're allowing the fund manager to actually do that call in terms of how much of mid caps and how much of small caps, and participate in the market largely, because they know that if mid caps and small caps do not have much juice in that, the fund manager will actually take care of that. So for people who have a certain level of risk appetite, which is higher than an investor in large cap, then flexi cap is an obvious choice. Somebody lower down on the totem pole as far as the risk positioning is concerned, they can definitely look at balance advantage kind of a fund where the equity component is far lower and the other portion is arbitrage, and the third portion is a debt. So there the exposure towards equity is much less. So if somebody wants really a flight to safety, balance advantage fund or typically a hybrid fund will be a good choice. Now, you also talked about aggressive hybrid fund. Aggressive hybrid fund, as the name indicates, typically has 65% or more as far as equity is concerned. Yeah, it is better than a pure equity fund, and it has a certain component of debt. So, and from that point of view, it is well positioned to reduce the risk in the portfolio, at the same time reasonable participation as far as equities are concerned.
All right, let's also talk about, looking at the rate cut scenario now, how much of your overall equity allocation should be designed. We all know that, we have some scope of earning money out of your fixed income also, and a lot of rebalancing of your portfolio depends on the kind of financial goals you've lined up for yourself. But do you think this is the time to maybe allocate a little more to debt, especially for a long-term purpose? Obviously, if capital preservation is one of your criteria or something that you're looking for, you can opt for this strategy. But having said that, can we also go in for a multi-asset allocation fund in the portfolio, where we will see the rate cut benefits coming to the debt category and also on gold?
So as far as the interest rate cycle is concerned, whether it is India or abroad, it is very, very difficult to fathom and correctly predict what will be the trajectory. If there is one rate cut, I mean, we don't know where, how many years it will take for the whole thing to unwind and where it will end. So we really don't know. So very broadly speaking, what you observed is absolutely right. That is, if you are positioned in the debt funds, you are going to benefit out of that. If you are going to be in a multi-asset fund where debt is one of the components, again, you'll be well positioned. But again, it all really depends on what is your objective and what you have invested for. So if somebody has some spare cash and they want to invest money in debt, because in their overall asset allocation, debt still has a, I mean, place in their portfolio, then they can position at this point in time. I'm not really otherwise suggesting new allocation into debt category, especially, I mean, after the taxation has turned adverse as compared to what it was at one point in time. So yeah, debt has a place in the portfolio, but I'm not advocating new debt just because of the interest rate cycle.
All right. So any kind of a momentum benefit you might want to earn, this is not the right strategy as far as your financial portfolio is concerned. When we talk about having money in the safer market cap categories, which over here I'm talking about large cap, flexi cap, and BAF, should we also try in for a large cap passive? Can that be a better route as compared to an active one?
Yeah. I mean, a large cap, for the most part, the passives have been able to comfortably beat the actively managed fund. That is shown by the SPIVA report. So, I mean, if you really want to invest in let us say a Nifty 50 or a Nifty 100, then I mean you can be absolutely spot on if you invest in a passive fund as compared to an active fund. I'm not here a proponent of active versus passive. I'm not getting into that battle at all. But as far as the large cap category is concerned, for the most part, if you are invested in passives and you will be able to do well. Firstly, as far as passive fund is concerned, it is going to track the index and the charges are very low. So from that point of view, passives are largely able to beat the actively managed fund for the most part. I mean, there are still actively managed funds which are doing better than passives, but the category is generally lagging behind passives. So it's a good choice going for passives, especially in the large cap category.
All right, Suresh, with that, it's a wrap on this part of the show. Thank you so much for being on the show and helping our viewers understand all of this today.
Thank
Thank
you
you.
very much. Thanks a lot.